Right, let's talk about bubbles. Not the delightful soapy kind you played with as a child, nor the fizzy kind in a glass of suspiciously cheap champagne. No, we're talking about financial bubbles, which are far less fun and infinitely more likely to make a grown man cry over his 401k. So, what is a financial bubble? Imagine you find a rock. It's a perfectly nice rock, but it's still just a rock. But then, your neighbor says, "Hey, I'll give you $5 for that rock." Then someone else sees this and offers 10. Suddenly, everyone wants a rock. The price skyrockets to $1,000, not because the rock is suddenly made of diamonds, but because someone else will pay even more for it later. That, in a nutshell, is a bubble. Asset prices inflating way beyond their actual, real-world value, all based on pure, unadulterated hype. This isn't a new phenomenon. People have been getting swept up in financial madness for centuries, from Dutch tulips in the 1600s to Florida real estate in the 1920s. The cycle is always depressingly similar. The dot-com story began with a simple, powerful idea: the internet. In the mid-90s, the World Wide Web was this new, exciting frontier. Visionaries saw its potential to change everything from shopping to communication. This sparked a wave of dot-com companies, startups with .com in their names, promising to revolutionize entire industries. Investors, captivated by this narrative, started pouring money into them. It didn't matter if these companies had a clear business plan or any revenue. All that mattered was the promise of future growth. A company could consist of 3 guys in a garage with a vague idea for selling pet food online, and venture capitalists would throw millions at them. It was a feeding frenzy. This initial excitement quickly spiraled into full-blown mania. The stock market went wild. Companies with no profits and sometimes no products saw their valuations double or triple overnight after their initial public offering, or IPO. Think about that. You could launch a company called Socks.com, spend millions on a Super Bowl ad featuring a sock puppet, and Wall Street would reward you with a $1 billion valuation. Fast forward to today. The frosted tips are gone, thank God. But the air is thick with a familiar scent. Hype. The magic word used to be .com, now it's AI, artificial intelligence. It's being billed as a revolutionary technology that will change everything. And like the early internet, there's a kernel of truth to that. AI is already doing incredible things, helping design new medicines, powering recommendation engines, even surfacing weird niche documentaries you didn't know you wanted. The potential is immense. Investors are falling over themselves to get a piece of the action. The parallels to the .com era are unsettling. We're in a new kind of gold rush. Startups with AI in their name are raising staggering sums, often off a slick pitch and vague promises. Big tech is pouring billions into AI divisions, and stock prices are soaring. Take NVIDIA. They make the chips AI needs. Their valuation has exploded. Not because profits jumped 10,000%, but because investors are betting they'll sell the shovels in this gold rush. The narrative is seductive. We're told AI will create trillions in value, cure diseases, solve climate change, and maybe even fold our laundry. Fear of missing out fuels reckless money flows. The same familiar stories pop up. A 25-year-old AI founder turned billionaire, an obscure software stock jumping 400% after adding AI to their pitch. Valuations detach from reality. Classic bubble signs. The question isn't whether AI is powerful. It is. The question is whether stock prices reflect real future earnings or a wave of speculative mania. Are we valuing fundamentals or just buying the hype to avoid being left behind? The .com lesson is clear. Revolutionary tech. Sound investment. Right now, the AI market looks like a party where the music is too loud and everyone's ignoring the floor starting to creak. So, is the AI boom the next .com bubble? Are we headed for an equally spectacular crash? The honest answer is maybe. There are certainly some flashing red lights. The sheer speed and scale of the investment, sky-high valuations for companies with minimal revenue, pervasive FOMO among investors. A single mention of AI on an earnings call can send a stock soaring, regardless of fundamentals. That's not investing, that's gambling on buzzwords. Markets driven by buzzwords instead of balance sheets tend to end badly. The moment that excitement cools, or a few major AI promises fail to materialize, confidence could evaporate just as quickly as it appeared. But there are key differences this time. Many leading companies are not profitless startups. Microsoft, Google, Amazon. These companies have deep pockets, diverse revenue streams, integrating AI into products used by billions.